Okay, here we go. We are going to do lecture 4A, and probably in this one I'll do parts 1 and 2, and the second part, parts 3 and 4 here. Speaking of the multi-period world, so we're parting ways with the previous lecture somewhat, and what we're going to do is let's do some just introductory bits on the multi-period world. And what we're going to do is set up a basic idea first off. And let's just leave the formal analysis of risk for later. So we're going to set that aside just for now. And just make a claim, right? Our claim is that across multiple periods, it's true that cash flows are going to be risky, that we have to use something called, instead of a certain cash flow, what we'll do is we'll, for purposes of knowing risks are really much more feasible in this pattern of cash flows, we'll see variation. That's what we mean by risk. So what we're going to use is a term, we'll call it expected cash flow, okay? Expected cash flow instead of the certain cash flow. And what we'll do is when we account for risk, we'll adjust the discount rate, okay? So the discount rate is adjusted when we have to deal with risk, okay? And so imagine that you had a market rate R. That's for riskless securities, right? And what we know from theory and evidence is that the rate for risky projects should exceed the market rate, okay? So risky project, right, it has a value of a rate of return, right? It exceeds R, the riskless security, which we'll call government treasury bill. And rational investors, right, the idea here is they require a higher rate of return when they bear risk. And what we'll do is make an adjustment to the return they want on that risky project, right, relative to the risk-free investment. A little bit later, we'll learn how to estimate the risk-adjusted required rate of returns for these risky projects. So what we're going to do now is we're going to run through a series of examples. The idea is that I'm going to work on some examples, and you should try them out. You should use a calculator, a spreadsheet, and try to replicate these, okay? And we'll deal with projects' cash flows. And try to basically, see my calculations, try to confirm them to see if you're using the devices that you've got handy in a proper manner. So what we want to do is, of course, say, well, what happens to a present value of a typical project's cash flows, its future cash flows, as the discount rate increases? Suppose R goes up. Okay. So, maybe we're dealing with a little bit of a risky project, right? So what happens to a project's present value, to its net present value, right? Now, when you have higher discount rates, this is reflecting increasing levels of risk, right? So that's the general theme we're headed towards, thinking about managing projects and trying to figure out finances with these projects. The intuitive answer is that the net present value should decrease as the discount rate, right? Net present value should decrease as the discount rate increases. Right? The project has a higher hurdle, we'll call it, than say the typical project when it has more risk. So what we'll do, go to second page and go to part A and think of a time component now, crucial in the multi-period world. So imagine the present value of cash flow 1 and expected cash flow 1 happened in that first time period. And before, when we weren't too worried about time, it was looking like this. Now what we're going to do is insert an exponent. This little guy right here is what we're interested in now. Okay, so you got to note this exponent. By the way, this is all, you can, especially chapter 4 in Burke and DeMarzo, see this material. Okay. Now we didn't have the exponent before. Now we do. You have to use the exponent. So in thinking of these and looking at the time periods, if you had time period 2, the exponent would be 2. If you had time period 3, right? If you had time period 3, the exponent would be 3. So we're going to make adjustments to the timing of the flows by identifying that exponent. Okay, and so the multi-period model has a general form. So generally, right, the present value of a cash flow in time period t is equal to cash flows in that time period. We're just identifying a moment in time, right? Over 1 plus r, the discount rate on the flows raised to the time period t. And in this particular arrangement, we're setting up CT. This would be the receipt of the cash at the end of the year, right? Where the flow happens at the end of the year. So the cash flow, we'll say, is received at end of year. We have to make that distinction because we make a slight adjustment if the cash flow happened at another moment in a year. Let's do a discounting example. So let's imagine we've got a flow of cash. Let's say 3426 is to be received in 16 years. What's it worth today? All right, so it's going to be received in time period 16. What's it worth today? And let's imagine r is equal to 8%. Okay. So there's a notation. We can rewrite this, right? We could say that CT is times 1 over 1 plus r to the t. And right, the right side part of this, right, that right side here, right, we're going to often refer to that, right, that's often referred to a discount factor. Okay, so we could take the present value formula, insert 3426. That's happened right in year 16. So it's in year 16. So the present value there is right. You know what? I always like to do it this way too. Just sort of I'll put it this way. It's in year 16. R is equal to 8%, right? And so what you do is go 3426. Say it's 3426. All right, times 1 over 1.08 to the 16th power. So this guy right here used to be put inside the old style calculators using tables that would help us find these discount factors. And you actually see in an appendix of the Ross Westfield Jaffe book one of these tables. So you can, in a table kind of method, you would look up, right, the discount factor. You would find that an 8% discount rate and 16 years had a discount factor. Call it DF, and on the table it reads as 0.008. 2919, and that's right, equal to $1,000. Right, so $1,000 is the value once you discount 3426. Let's do a compounding example, the reverse, right, of the discounting example. So you, let's say, got $1,000. Say in year 0 right now. Oh, imagine that we're wondering, well, how much is it worth in 16 years? What is it worth? What's it worth in 16 years? Let's say R is 8%. And so you already know intuitively the answer, but look at the calculation. Say we're dealing with the future value of something. Now this is happening in year 16. It's a cash flow received now, right? So it's the cash flow now times 1 plus R to the T. Now we're dealing with a compounding formula. The script on the FV is indicating a reminder to us that in the future we're thinking of as T is equal to 16. You don't have to have that subscript there. I'm just trying to keep it clear. And so, right, the future value, 16 years from now, cash flow 0 of $1,000, right, is that $1,000 times 1 plus 0.08, 1 plus 0.08, 1.08 to the 16th power, and that's 34, right, 3426. This should not surprise us, right? 1 plus R, right, 1 plus R to the T is called the compounding factor. When you're multiplying the earlier received monies and trying to find out its future amount. And so, of course, the compounding factor, you see, is the reciprocal of the discounting factor. Right. So there's our two primary calculation formulas. Now, let's imagine a simple interest issue versus compound interest to see what is going on. Simple interest versus compound interest is something of note. Imagine, say, what would the simple interest be? Say, simple interest. Let's imagine that we're dealing with just $100 at 12%, right, for 50 years. How much would that be? Well, the interest in the simple framework is $12 per year, right, for 50 years. So 12 times 50, right? That'd be just a simple amount. So the idea with simple interest is that you do not earn interest on interest. The idea being, suppose you withdrew this interest that you earned each year and, just put it in a cookie jar. So at the end of the 50 years, right, you would have your principal amount, the $100, plus your interest that was paid and withdrawn, right? You'd have a total of $700 after this entire period. So the contrast this sum is crucial if you have interest that's compounding. So, right, compounded interest, imagine is looking like, okay, so $100, right? Right, times compounding. The compounding rate is running at 12%, so 1.12, and we got to raise that to, right, the 50th power. And running that guy through a basic calculator, you see this is 28,922 cents. So you have, right, this is the interest, right, that you earned, and your original principal was $100, right? So right, thus you have, out of the 28,922, the principal amount is included, right? It's included. So the principal is 100, and the interest earnings, which was an interest on interest process, right, was the remainder that you earned, right, which was here 28,822. This, of course, is a radically different sum than when you had simple interest, right? In the compounding format, you see a huge difference, and in this case it's because, right, the time horizon is so long. Okay, so that's important to highlight. Now let's look at multi-period cash flows. So multi-period cash flows, suppose they're received several time periods are involved now, and the cash flow is happening at the end of the period. We could, of course, calculate the present values separately. You could do this, say, with a spreadsheet pretty easily. And, of course, we have to discount them after we adjust the discount values if we need to, right? And so the general case, the general formula, is just sort of extending from our basic formula, what we know. So take cash flows that receive in time period 1, discount them by 1 plus r to the first, right? Imagine you get cash flows in time period 2, discount those also. And 3, discount those, right? And we're doing this at the end of each year. And you can keep going until you get to some moment n, some time period n, and that's going to be discounted by 1 plus r to the n. And n is, right, the last period you receive your cash flow. In shorthand, for some mathematical guru types, we're saying that the present value, right, is the sum of cash flows received in time period t, discounted, right, at 1 plus r raised to the t, where t is running from time period 1 to time period n. Now recall net present value was equal to, right, the present value of the inflows minus the present value of the outflows. And with the term present value in place, we are, right, we're measuring all the cash flows in time period 0 equivalents. So, special case. Let's imagine that there's a 10% discount rate. It's an example. Let's say that a project costs $200 in time period 0. And let's say it needs to have another outlay of money. Maybe this is something like CapEx expenditures. Let's say it needs an outlay of money of 100 in time period 4. And let's suppose that the project in time period T1, right, time period 1, it brings in an inflow, right, of 100. In time period 2, it actually brings in, let's say, 200. In time period 3, 75. In time period 4. Oh, let's say that's an outflow. Sorry. So wait. Let's say it doesn't bring in any money at all in time period 4, right? So in time period 5, let's say it generates 300 in time period 5. Okay, so these are inflows in those specified times. On the typical timeline example, time flows, and we have time period 0, and 1, 2, 3, 4, and 5. So right, time period 0, I have a cost of 200. Right, let's write that as a negative 200 for my flow. In time period 1, we got plus 100. Time period 2, plus 200. 375. Time period 4, I invested another 100 in this project. Time period 5, I get 300. Right? At a 10% discount rate, I will have to discount each flow and use the time period indicator. So for instance, if it was time period 5, the discount factor would run 1.10, right, to the 5th power. So let's put the present value on the next line down and write, of course, minus 200. 100 received a year from now, discounted at 10% is 91, right? 200 received into the present value. See, that's received in year 2. That's 165. $75 received in the 3rd year, discounts. That's down to 56, right? Now the value of the outflow at $100 at the year 4, so that's minus 68. And then in year 5, I've got 186. So I will add up this series of present values, and that'll generate for me net present value, right? Then the net present value is just the sum of that row of values, numbers. It's got a net present value of 230, right? And now, so that's what if we say, okay, it's got a net present value that is positive, so the project creates value, and we should accept it. You should know what it is that the $230 means to the shareholders of the firm as they evaluate this project that we put in place, right? What is the meaning of that money? Is what's crucial. It's value that was created in the project, right? Let's do perpetuities. This is an investment that provides cash inflows that never go away, right? They will be perpetually experienced, continuing into infinity. So the idea is, right, C1 is received, that equals the flow of C2, this flow of C3, right, all the way out to time period n, where n is equal to infinity, right? Does this sound like a preposterous investment? It actually is not. Real-world examples like preferred stock dividends, interest payments from a console bond, are giving you interest and dividend payments forever, with no return of principal. So such a security has no maturity date, right? And the payment each period to the owner of that security is an identical payment. So how do we find the present value of perpetual cash flows? Your calculator and your spreadsheet do not have infinity sort of functions, right? So it could be very tough and very long job to pull off, but there's some algebra that has helped us out a little bit in this process. So step 1 is to recall, right, just think of what the present value is. So that's the cash flow, time period 1, right, discounting to 1 plus r to the first. And you get a cash flow again. Now this is the same cash flow each time, so yeah, it's probably just as simple for me to, since it's the exact same value, to say cash received. Okay, we'll discount it to 1 plus r to the first power. Okay, we'll receive it again, and discount it to the second power. And we'll keep doing that forever and ever and ever, right? So finally, in the moment of infinity, it's 1 plus r to the n. Now you can multiply both sides of this equation by 1 plus r to the first power, right? So you'd have the present value, it's the second step, right, times 1 plus r to the first. Okay, so that equals cash plus, okay, say now, it's cash at 1 plus r to the first, and then cash 1 plus r to the second, and so on. So this is how it looks. And then finally we have, right, C received in time period 1 plus r to the n minus 1, just one period before infinity. Now you can subtract equation 1 from equation 2. So if you do this, what you'll notice you'll get, so equation 1 from 2. So the present value, 1 plus r to the first, minus the present value. And you see that's equal to c minus c. And there's only one slight difference, right, between those two equations. It's 1 plus r to the n. Now n goes to infinity for the perpetuity. So under such a condition, right, under that condition, this final term of this equation, this, right, with n going out to infinity, right, this has to be 0, right? You should ask yourself why. It's a pretty straightforward answer. Now we can expand this equation a bit. Note, right, the present value, say, plus the present value times r minus the present value equals c. And we got present values here distributed everywhere. I just expanded the equation. So I'm expanding this difference, right? And this, right, works out to a present value. So we've got 1 plus r, right? So that's why I've got PV plus PV times r. Okay? So present value is sitting in each of these elements, each of these parts. So I've got, right, 1 plus r minus 1. Right, that equals the cash flow. Well, 1 minus 1. See, it's 1 minus 1. So I've got present value times r equals c. So the present value, and this is the perpetuity formula, right, is equal to the cash flow over r. So there we have a perpetuity formula, right? And let's do an example. Just put it out here in the box. Let's say, what would you pay to receive $100 at the end of every year forever if you were getting R of 10%? What would you pay to receive $100? The end of every year. Okay, say year end forever. And thus you could give it to your heirs as well. So the present value, right, would be the $100 in cash flow, right, divided by R of 0.1, and that equals $1,000. If you invested $1,000 at 10%, you could draw off the $100 per year and never touch your principal. So it makes sense the value of the investment is $1,000. See, with this $1,000 investment, you're constructing your own $100 perpetuity given the 10% interest, right? So that has to be the value of the perpetuity, right? So let us consider an annuity. Do I want to do annuities right now? I think I said that I was going to put those into my second example, so it's time to stop recording, and that's pretty good 30 minutes of example work, okay?